Hi, this is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. Usually I'm looking for potential multi-baggers or types of stocks that I think could potentially go up hundreds or even thousands of percent over time. A lot of folks have been asking me about Wish stock, W-I-S-H, or ContextLogic. It goes by really the operating business, Wish, which is one of the top e-commerce websites for people looking to do a little shopping, a little bargain hunting. And this video is saying, hey, let's do a deeper dive on Wish. Let's do a deeper dive on this business model because the stock is down about 50%. At one time it was down even more. Since its IPO last year, it's gone volatile in the last few days, jumping around 20, 30, 50%. And so folks are wondering, well, wait a second, what's the true North Star here? What's this business fundamentally worth, and what could this be worth over time? Is this potentially bargain hunting territory? In this video, I'm going to talk about not only their business model and their prospects and their historic growth, but also take a deeper dive in terms of some of the red flags that I'm seeing that make me less confident that the business has really sort of reached a sustainable level or a sustainable business model, and that they still need to prove themselves before I personally get comfortable. Let's dive deeper into this right now as we look at it. So first of all, this is the Wish stock that you can see over the past year since it's IPO'd. Quite a volatile ride, started trading in the 20s, went up to nearly 30 bucks a share, then went down below 10, recently closed around 10, down 50% from the IPO. And recently, folks are starting to wonder, you see the Wall Street bets, pick up, where people are wondering, is this either a bargain stock? Could this become a meme stock? You see a high short interest. So people are wondering, hey, could this go parabolic like some of the other, I'd say, lower quality companies like AMC that has sort of had a parabolic rise. And, the part that gets me interested in it is seeing that the price to sales valuation is 2 times sales for a company growing over 30% in 2020. First quarter growth was on fire, and they have really juicy gross margins of 50 to 70%. So I'm liking this sort of first look. This is how I'm, a lot of folks ask me, hey, Daniel, can you break down how you look at a company? And I'm sort of sharing this thought process here of like, okay, let's go through the steps. Okay, so the first is like psychologically, this thing's beaten down. Second, if you're finding a company that's going to be growing at 30%, let's say for the long term, and it has juicy margins like this, I know a price to sales multiple of 2 times, that could be really juicy, really advantageous. And so now I want to actually start understanding what's the business model, what's it worth. And in order to understand that, we need to understand the revenue drivers and what's their value proposition. That's the basis of this channel. Is I'm always trying to find unrivaled value propositions where a company offers a good or service that you just can't get elsewhere that gives them the right to win longer term. So that's why this channel is called Unrivaled Investing. So let's dive a little bit into Wish to sort of understand what's their value proposition. And so they talk about how their mission is to bring an affordable and entertaining mobile shopping experience to billions of consumers around the world. The way I would sort of break this down into layman's is that it's cheap goods for value shoppers around the world trying to get exposure through e-commerce. So really like bargain hunting, e-commerce, cheap goods. And their angle is that like, hey, value conscious consumers have been left behind by e-commerce, saying, look, people below $70,000, households making less than $70,000 in income, it's a huge number, and these people, they're saying, have been left behind. I don't agree with that angle, because the whole value proposition of companies like Amazon is bringing everyday low prices. And you look at Costco and it's everyday low price. You look at the dollar stores and it's trying to bring everyday low prices. And so their angle is saying, hey, these lower socioeconomic pictures from around the world, they may not get the e-commerce angle, or they may not be able to buy cheap goods or benefit from e-commerce shopping. And so they talk about how Wish users have an annual household income less than $75,000. That's 75% of their users. And they say 75% of the people surveyed prioritize the price of an item over the brand and delivery time. So that's a key point when thinking about this business model, is that these folks, they're saying most people actually don't care about the brand or delivery time. If it takes a month, so be it. They're just happy to get a deal. And so they're saying this is a global opportunity. This isn't a U.S. company. This is a global company, U.S., Europe, Asia, Africa, saying, hey, lower income shoppers. You're not talking about, let's say, a lot of folks think the higher end shoppers like go to Amazon Prime, and those, so they're saying, hey, for everyone that's not using Amazon Prime, hey, the people should consider Wish for their sort of discretionary purchases, for their gifts or bargain hunting. And, the perfect example of people not caring about the brand is, you look up Legos on Wish, and I did this just a little while ago, so they talk about how you can buy this Titanic type replica, hey, there's an iceberg, watch out. And so instead it would cost like $99. Whoops, oh no, it's not $99 on Wish, it's only $29. But the reality is nowhere here does it say Legos, so like when you think you're buying Legos, you're really buying Schmegos or something like that. So that's just part of it. You should think that the vast majority of the products here are coming from China. And, taking a step back, they have built a real company with $2.5 billion in revenue, 107 million monthly average users. So people going to their website. There's a fine line between people going to their website, shopping, browsing, versus actually buying products. We'll talk about that in a little bit. 550,000 partner merchants. The way to think about this is these are the suppliers. These are the small one-off, merchants, factory suppliers that are selling the Schmegos Titanic set. And, it's across 100 countries, and they have 50,000 Wish local partners. This is one of their relatively new initiatives about saying, hey, a lot of these countries with e-commerce, it's actually sort of tough to make it work. So we have to work with local brick and mortar so that people go to the brick and mortar to pick it up. And so that way it's cheaper than having that last mile delivery. And so that way it enables a business model like Wish. And so they're saying, look, we are a global e-commerce platform, 100 plus countries, 2.5 billion in revenue, growing 34%, 33% last year, and a lot of people are looking at it every year. And they say, look how many people, monthly average users, has grown significantly, from 21 million back in 2015 to 107 million, so 5x over the ensuing 5 years. And then you could see how they've had a nice revenue growth over the last few years. It has been a little bit choppy. In 2019, it was only 10%. Then in 2020, it was 34%. Largely aided by this new logistics segment. You can see how it wasn't crazy growth just looking at marketplace. So you start seeing, as you start building out, okay, so I start understanding the value proposition. It's about selling sort of these cheap goods around the world. And now I want to understand more about this business model. And ultimately this business model is you get more and more people going to the business, shopping, and then hopefully clicking through. And so let's peel back that layer a little bit or understand in further detail. So you can see their geographic exposure is being about 40% North America, about half in Europe, and then a little bit in South America, rest of the world, Southeast Asia and such. And so then, or Africa and South Africa. And then their revenue is primarily their marketplace, core marketplace, as well as logistics, which has grown hyperspeed, 275% year over year in 2020. We'll want to dive into that a little bit more in a second. And this product boost. So let's go through these different components, core marketplace and product boost, and then logistics, because that will give me a better feel for how this business is working. And so the marketplace business, so we provide a mix of marketplace services to merchants. This is from their 10K. We provide merchants access to our marketplace. Look, that could be valuable. If you have 100 million people going to your website each month, that's valuable for these 500,000 merchants to sort of sell their wares. And so they're saying, look, we provide access to our marketplace where merchants display and sell their products to users. Marketplace revenue includes, so this is the key line, commission fees collected in connection with user purchases of the merchant's product. The commission fees vary depending on factors such as user location, demand, product type, and dynamic pricing, i.e., the amount of money that people spend on the platform, they get a cut of whatever that purchase is. So it's the product, the gross merchandise value that goes across the platform times by the take rate. So whatever percentage they get, that equals to this marketplace revenue. And that type of business model, this marketplace business model, is a very juicy business model. This is the type of business model that has very high margins, 40% like operating margins, can be super lucrative. It is beautiful. It is a toll booth type of model. Hopefully it's not a phantom toll booth. And so we'll want to understand that a little bit deeper, particularly because they actually don't disclose the GMV, which is a little concerning. They sort of dance around this issue. I personally, that is a red flag that you don't disclose it, or at least I haven't been able to find it. So if you see it, I'd love to see it. It's at most I've seen estimates of this. And so then, you keep going and okay, so that's the marketplace. Then the next component is product boost. So this Product Boost and Marketplace, that gets to about 80% of their revenue. And Product Boost is really about advertising, where the merchants effectively help their market placement of saying, hey, we're selling these goods on your marketplace, on the Wish marketplace, but we want to stand out. So if someone's buying headphones, they know to buy our headphones. So here it is, VIP outlet. They had something like a 34 increase in average order value and a 484% increase in impressions. So people that are looking at their products when they use Product Boost. The way to think about this is the first one's a commission model driven by the consumers, and this is the vast majority of their business. 80% of their revenue is driven by users buying stuff on their platform, buying the schmagos on their platform. And then the next up is, hey, the merchant saying, hey, we like this platform. This is an oxygen line for us. This is our lifeline. And so we are going to spend more money on this platform to make sure we continue to survive and we continue to grow. And so this is about enabling merchants. And this too is an incredibly lucrative business model if you can get it. And so then the next component, so that covered the 80%. And those two business lines, from studying other businesses, I know can be extremely lucrative. A perfect example of which is Alibaba, a stock that I own. I'll talk about it again at the end. That is a business that started off with a marketplace model in China, and it's incredibly lucrative, very high profits and free cash flow. So I know that this could be lucrative over time. Let's keep going. And so then this logistics component, they talk about how they launched this in 2018. It's designed for direct end-to-end single order shipment from a merchant's location to the user. Logistics services include transportation and delivery of the merchant's product to the user. Merchants are required to prepay for logistics services on a pre-order basis. Okay, so merchants can't sort of game the system. They can't do a prepay for the logistics services. So what they do is they say, hey, you have to prepay for this on a per order basis. So every order that you're going to do, there's going to be some sort of logistics charge. And their logistics services have a range of benefits. Like first mile means it's a collection of the packages from a bunch of different vendors or from a bunch of different suppliers. Then it's bundling the orders into one package or one package that then gets transported to the country. So they need to coordinate these logistics. Then it's the warehousing. And this is part of their initiative also to improve their delivery or their time to get to the end consumer, is by saying, hey, can you do this sort of drop shipping equivalent where you send it to our warehouse and then we'll figure out how to get it to the consumer. But they don't count it as a sale until there's fully a sale. And then it's the last mile, like, hey, if we have a lot of packaging going through our warehouse, can we cut a special deal in different countries? So this is their logistic business. You could understand why this would grow over time and why merchants would want to pay for it, because it increases their value proposition to the consumer, because it means you're getting it on time. And this business has been on fire, where when you look at this logistics growth, $245 million in the first quarter 2021, 338% growth year over year. They're talking about how this growth was driven by improved monetization and strong merchant adoption. So once again, what I was just talking about, merchants need this. They recognize that this really results in better orders when they're able to say, hey, you're going to get this in short order. Be focused on optimizing average time to door. This is what I was just talking about, driving shipping efficiencies and encouraging more merchants to forward deploy inventory in bulk to stored with a local warehouse partner. As a result of our initiatives to add more local and forward deployed inventory, so this is inventory that's, let's say, shipped from the factory in China to the warehouse in the United States, Wish Express listings increased 414% year over year. This makes it easier for them to ship directly to consumers in less time, which they talk about an average direct time to door of 5 days or less. That's a big deal, because a lot of people would buy things, then you'd get it a month later and you were turned off. You thought your schmagos, you're like, hey, this was a great deal. And then you're like, wait a second, it took me 2 months to get it. I didn't even get it for this little cousin, I didn't get it for cousin Ben's Noah, cousin Ben's schmagos, and he didn't get it for his birthday. And so that's a big deal, because you want to be a good uncle to your nephew Ben or something. So anywho, that's a big deal, and that's why you got to fix your average time to door shipping. You got to fix how long it takes for you to get to your customers. And they're working on more deals, strategic partnerships with local carriers, including a direct integration agreement with South Africa Post. So that's an example of, hey, as you get scale, you're able to get better and better deals. But it's worth calling out for a second that this is all fine and well, and it's great to see this adoption by the merchants saying, hey, we want to improve our sales to end consumers. But what's really going to drive this business long term is not logistics. It's going to be more and more customers going to their website, finding the value proposition of the Wish platform to be attractive. So you need to remember that as you look at these numbers. And so let's keep going as we think about that. And so they talk about this flywheel where they're effectively saying, hey, the more merchants you get on here, the more attractive offerings you get. So that way you get more monthly active users and more active buyers. And then, you get user personalization, so you can figure out exactly what you can charge different users from around the world. Oh, they showed up 3 days in a row. You know what? You can charge them a little more. And they gamify the experience to encourage you to show up more often. Or they like, hey, you just showed up and you didn't show up for a month. You know what? Now you get an 80% discount. And so then the product boosts because more and more merchants go on because they see the customers are there. And so because you're able to get more and more merchants, it becomes cheaper to acquire new users. So this is a beautiful flywheel if you can get it. But we actually need to dive a little bit deeper. So everything so far looks good. But this is the reason why with all investments, you actually need to put on that thinking cap and let's actually look at these pieces a little more carefully. And so for example, this core revenue driver, this product boost, this ad revenue effectively for their business, throughout 2020 was down significantly, down 34%, 36%, 32%, 24%. Only in the first quarter of 2021 was it up 14%. And so you go, wow, this means the merchants aren't really going crazy over this. That means, like in my take, if I see the merchants aren't looking to spend ad revenue on a platform, it either means, one, there's something exogenous going on, like an exogenous event like COVID, and we'll talk about that in a second because clearly COVID did play a role. But also, I suspect with these merchants, with these suppliers, that Wish isn't the only platform they're selling on. Maybe it is, but for many of them, I suspect they have a factory, and Wish is one of their end channels that they use. And so if they're looking across different channels, they're probably going to say, where should we direct our ad spend? Where is the best return on investment? And so if you're seeing a huge decline, that is sort of a warning sign, especially in the fact that you look at e-commerce globally in 2020, and e-commerce 2020 was a huge year, a great year for businesses, including marketplace businesses. And so this is a little bit of a red flag. This is another red flag. You didn't disclose GMV figures, and I see that merchants really aren't stepping up. That means they're not seeing the volumes that they want, that makes it worthwhile for them to advertise, in theory. The way management explains it, however, is slightly different, talking about COVID having a big impact, saying, look, during the initial outbreak of COVID in China, our merchants' advertising activities declined materially due to a significant shutdown of business activity in China. That's just a weird explanation in my mind, because I'm thinking, yes, it's possible factory definitely did shut down, production did shut down. But you'd still need to generate revenue, and e-commerce is one of the best ways for these factories to do it versus, let's say, brick and mortar. And so I'm thinking about this, and I'm like, it rubs me the wrong way reflecting on that. The next component that they talk about is that in the second quarter of 2020, because consumer demand increased significantly on our platform for the reasons stated above, many merchants did not see the need to pay for advertising like they did in the past because they experienced very robust consumer demand without incremental advertising spend. So, i.e., more people were going to their platform to shop, so advertisers didn't need to spend. And that also sort of bugs me because it's like, well, wait a second. If you have more eyeballs going to the platform, isn't that the time where you really want to stand out and shine? Isn't that the time when merchants are like, oh yes, we definitely want to be on the top of the pile when you're looking at Schmegos, when you're looking at those headphones, those Dreets headphones, whatever it is. And so that's not Beats, Dreets. So that's it strikes me as a weird explanation. Whenever you see a decline like that, it is a little bit alarming. That said, they did post some growth in the first quarter 2021. So back to growth now. So what's more, digging into this business model. So, okay, they're running at a loss, but let's actually understand what's driving the loss, because a lot of companies these days get a pass for operating at a loss. And you can see that every year, for the past 3 years, their sales and marketing has been in excess of gross profit, i.e. for every schmego that they sell, the profit that they get from the commissions from the schmego sales and for the advertising, that those gross profit dollars, which are very lucrative, somewhere between 60 and 80%, you can see over the last 3 years, 60 to 80% gross margins, extremely lucrative. They spent more on sales and marketing. Now, that in and of itself could be a red flag. Like, wait a second, why do you need to spend so much on sales and marketing? If you are to do that, in order for this business to be justifiable, to spend more on sales and marketing than gross profit, in order to justify that, you have to say, well, the unit economics need to be favorable, meaning you are rapidly acquiring more and more active users who are going to be actively purchasing items, and the lifetime value of those purchases are attractive. And so this is the ratio folks in Silicon Valley oftentimes think about. This is something I was well aware of back when I was working on the buy side at a multi-billion-dollar hedge fund. Is you need to consider what's the lifetime value to the customer cost, the cost of acquisition, customer acquisition cost. So looking at LTV to CAC and what's going on here, and here it is. What you see in their financials is that they're active buyers. So someone who actually bought something in the last 12 months, it's gone nowhere. It's gone nowhere from 2018 to 2020. It was 64 million, 62 million, 64 million. That is another big red flag because you're spending more than you have on gross profit on acquiring these customers. This is a huge concern. It means the unit economics aren't working. You need to have this building over time in order for this business model to be justified. And management is aware of this, as I'm sure plenty of bankers have been asking them about. And so they even call this out to an extent in their most recent quarterly letter, where they talk about, we continue to strategically focus on acquiring and retaining high lifetime value users within the value-conscious consumer category. First quarter core marketplace revenue per active buyer increased 76% year over year. This is a big deal. They're saying core marketplace revenue per active buyer, so the buyers that are on their platform, they spent 76% more year over year. In addition, the percentage of orders with a transaction value above $20 increased by 54%. So more and more of these orders are above sort of maybe a sustainable threshold, meaning a lot of their orders are below $20. I mean, when you're talking about global shipping, shipping a schmego set from China to, let's say, Idaho, shipping alone is going to cost you. So that's going to really eat into those margins. In some emerging markets, and this keeps going into the equation, the unit economics, in some emerging markets where we believe users have lower lifetime value, we temporarily decreased our advertising spend. That's a key point. That means we can't make it work at this point. Like at this point, whatever business it was, it's not working. We are temporarily decreased our advertising spend. Like, this isn't working. Across all markets, we are de-emphasizing low-value items, which tend to have high conversion rates but unfavorable economics. Well, of course. I mean, this business model is struggling to work. Yes, on a first-level analysis, it seems interesting, but you have to peel it back a little bit to actually understand what's going higher. The reason why this ad revenue per active user is up is they're saying, hey, we need a transition. We need to pivot these buyers to buy higher priced schmego sets. You can't just offer these free items, and this is actually still on their website to a lesser extent than what they used to, because I checked out Wish a year or two ago to see, hey, what the heck do you have? But you can still see they do have these loss leaders of strong, super strong pull magnets, 99% off for 50 cents, or it looks like a USB-C cord or something like that for $1, or free. You can get this charm bracelet with some astrology stuff going on. I mean, hey, who wouldn't want a free astrology bracelet? Just pay for shipping. Of course, this business model isn't sustainable as you look at something like this. At least that's my take. And looking at what they're starting to say is, hey, we're de-emphasizing these things. And they talk about, okay, well, we need to make sure the users who are buying stuff buy more expensive schmegos. And the effect is that the monthly average users declined 7% year over year to 100 million. So it declined. The people on their platform going to the Wish platform are no longer finding their deals interesting. And the active buyers also decreased by 3% year over year to 61 million. Another like big warning sign. This business model is in transition. They need to figure out, they need to get their stuff together. They need to figure out how to make this work, because so far spending more on sales and marketing for priced tchotchkes isn't working. It's not resulting in long-term value for the customers. Repeat customers keep coming. And I look at this and I'm thinking, at this point, the reality of this business is that they do not have a proven business model. And so it is very difficult to value this business. And so, they make the case, well, look, we'll have higher margins in the future once we work out this logistics stuff, and then we can get more, sustainable shoppers that'll keep going to the platform. And you could say, hey, I heard that Amazon's been one of these monster stocks, and I always see those advertisements. I bought this Amazon stock when it was in 1999. Don't you want to be like me and make tens of thousands of percent? Well, wait a second. Like, Amazon, let's actually understand the case with Amazon. Let's get in that time machine. Go back in time, check out Amazon's numbers. And you know what? That initial argument of like they spent more on sales and marketing than gross profit, that's actually true. From 1997 to 1999, they did that. In 1999, you can see they spent $413 million on sales and marketing, which was in excess of the $290 million that they spent. Now, one should understand that Amazon was also operating a very different business model. Amazon had a 1P business model. They were taking on the inventory effectively and selling it. Their margins were very low versus a third-party marketplace business model that they evolved to over time, where that resulted in much higher margins. So here it is, you have very different margin profile to have this. So I would argue there's a reason why Amazon needed to do it versus something like Wish, where you already have these big fat juicy margins and they're still spending more than on sales and marketing than gross profit. But let's play this, let's pull this thread further with Amazon, because in 1999, that's, the stock was on a rampage. It ultimately peaked around March or April 2020, or excuse me, 2000, not 2020. And, by 2000, like if you look at their results, well, by 2002, 2003, they were actually proving themselves to be a viable business model, where here it is, their gross profit was nearly $1 billion, and the amount that they were spending on fulfillment and marketing was significantly less. Where here it is, nearly $1 billion in gross profit and only $500 million on fulfillment and marketing. So this whole, sales and marketing, you could say. And so at that point, I would say, yeah, this business model, they've proven themselves. They started to prove themselves in 2001, 2002. 2002, it was here. And this is where, like, hey, well, you don't want to miss Amazon and their story. Well, wait a second. Like, at this point in 2002, 2003, when they were, in fact, proving their business model, the stock was down about 50 to 90% from its peak when they were putting these numbers up. So this whole argument, like, oh, by the time they prove it, you'll have missed out. Not the case at all. And so here it is, down significantly. And critically, this is the key point, is that from this time, and from 1997 to 1999 to 2002, every year they were growing more and more active consumers, more and more active purchasers. Unlike what you're seeing here with Wish, where effectively the stock has gone, where effectively the active purchasers has gone nowhere for years. That is a big concern, that sales and marketing was effectively burning money up. And so what about the valuation? Like, what should you think about it given these concerns that I've mentioned already? And so here it is. I'm going to do a quick plug where, first of all, if this is your first time tuning in, my name is Daniel. If you enjoy learning about stocks, learning about potential multi-baggers, please make a point of subscribing. If you're already a subscriber, I do appreciate you hitting that thumbs up. And if you want to follow my personal journey as I'm looking for unrivaled investments, potential multi-baggers, go to Unrivaled Investing, click on Journey. Each month, first week of the month, I call out my full portfolio, my top holdings, the reason why, and then throughout the month, I call out at least one idea that's a potential multi-bagger or a stock that I think has that type of hundreds of percent type upside over time. So that's at unrivaledinvesting.com. Let's keep going into Wish. And so as we look at Wish, I honestly, So first of all, their second quarter 2021, they're expecting much slower growth, 2 to 4% growth in the second quarter 2021. So that is a little bit of a red flag. That said, they're like, hey, long term, they think 25% annualized growth from here. That's, hey, who doesn't want pie in the sky? Then the next component is they're going to have even higher gross margins. That is potentially possible if you do get to scale, because that trend's actually been going the other direction, because their logistics business is very, very low margin. So they've gone from literally 70% to about 50%, mid 50s. And so, if you get scale in logistics, yes, that can start going back higher. And then the next component is, hey, then we can scale back the sales and marketing spend. And hey, if we scale back the sales and marketing spend because customers love the value proposition, we can have really juicy profit margins long term. I'm looking at this and I'm saying, you know what, it's just too early for me to say that's the fact. If you're a super speculative investor and you want to, gamble on successful pivots, successful transitions, good for you. God bless. I hope it works out. As an investor, I prefer seeing the fundamentals play out. And you get to see, that's the whole point of me showing you that Amazon example, is these things play out over time. You can see it play out, and you may even get a better price, as in the case with Amazon, when the story is actually started to play out and it becomes more obvious, hey, you have a sustainable business model. So these long-term financial targets that management has put out, I believe they require a lot of faith. I'm very skeptical of them. I don't buy it. That said, if they do deliver, that's a big if they deliver, you do have a lot of upside, because if you're able to have a business that grows, let's say 10 to 20% a year plus, and you're able to have juicy margins long term, you're going to have a great ride as an investor. Because from 2 times sales, if you're able to get to 20 to 30% profit margins and 20% growth, you're going to be looking at a business that's, let's say, 10 times sales. So automatically you'd have a 5x valuation expansion plus revenue growth. So that, that alone, you'd have a double plus 5x. So you're looking at 20x upside. That's a huge if they're able to actually deliver. When I do that back of the envelope, I'm thinking, look, folks, whenever you're looking at any investment, you need to think about 3 different components that drive your return. It's that simple with every stock. It's, what is the growth fundamentals? What are the fundamentals of the business? What's the cash flow? Are you getting any cash flow as a shareholder? What's the valuation? Every investment, you should be able to break down in 30 seconds or less, 10 seconds, what's going to drive your investment return. Okay, so here, if you're a bull on this, you're saying, hey, I'm going to get 10 to 20% growth. Someday I might get cash flow. I'm ignoring that for now. But if they're able to prove their business model, so I've covered their growth 10 to 20%. If they're able to prove their business model, big if, I'm not a believer quite yet, I'd love to see them execute, then someday you could have valuation expansion, in which case this thing could trade, let's say 5 to 10 times. If it's at 10 times sales, and let's say sales double from here, then it's really like a 20x return from here. So that's sort of the back of the envelope way to think about the upside potential when you're looking at it. I don't believe it yet, as I've already articulated. I want to see proof before buying in. That said, maybe people love their schmegos. That said, I do think that there are other business models that have proven themselves that still give you that China exposure. Here it is, you effectively have China supply exposure with Wish. But I look at this, and I think there are companies that are more compelling out there. As I already disclosed, I own stock in Alibaba, or Baba stock. You can watch this video on Alibaba and why I like it, why I like the valuation. And there are better plays out there, in my opinion. And for example, for the Unrivaled Investing Journey subscribers, each month I call out a potential multi-bagger idea. My main potential multi-bagger was a stock that I think has 2 to 3x upside and trades below liquidation value. And for June, I called out another stock that I think has 200, 300% upside. So that's what I'm thinking. If you have different thoughts on Wish, if you think I'm being too conservative, if you're seeing data points that prove to you that this business model is pivoting, or if you think I just missed something, I'd absolutely love to hear it in the comments below. This channel is not about hype. This channel is about finding the truth. So if you have a different perspective that you believe, hey, Daniel, you're missing it, and here's the reason why I believe they're going to execute, love to hear it. Leave it in the comments below. And if you enjoyed this video, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. Thanks so much for watching.